to the Capital Discussions Roundtable. This is Tom Nunemaker with Marc Principato. Before we get started, a quick disclaimer: the Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And with that out of the way, just basically we're not telling you what to do. You're a trader, so make your own trading decisions, right? So, Mark, I'm turning the ball over to you, and welcome back. I think it's been a while since you've been on the roundtable, so maybe people are familiar with who you are and what you do, so maybe a quick refresher.
Yeah, great. Thanks a lot, Tom. It's nice to be back. Hi, everybody. I'm just going to introduce myself real quick. Let me just get my screen up. I know you guys can hear me. Let me just get my screen share, and all right. You already heard the disclaimer, so that's mine. I don't think I have to read mine, right, Tom? I mean, you already read yours. It's the same thing, pretty much.
Yeah, same thing.
Okay. So I'm not going to read that. But anyway, hi, everyone. So let me just get this thing organized here. All right. So again, my name is Marc Principato. Today, I'm going to talk about something interesting here. I'm calling this the real reason why 95% of new traders fail. Now, that's just the title. This is what I want to go over here is really the thing, like the main thing that turned me around as a trader. People ask me that a lot. And, you know, everybody's always looking for systems and things like that. And I want to talk about a directional process that I use to manage my trades across all time frames, not just scalping or not just day trading, really the larger time frames, which would be considered swing trading. And that's where the bigger moves are. You know, people always have a hard time with the bigger moves. But anyway, before I get into all that, I want to talk about a few things that got me to where I am now. You know, I've been doing this for a while. So you know what you're going to learn from this, all right, and this is what I want you to take away is the first step to organizing your market information in such a way that is relevant to the natural market process. This is where the big mistake is, because people are always focused on the wrong information, or they weight information that doesn't really mean anything. They give it too much weight. So that has a lot to do with perspective, okay? And I train a lot of traders, and this is the thing that I've learned that holds a lot of them back, and I realized it helped me back for years also. So just a little bit more about me. I'm not going to spend a lot of time on me or how I got here, but I started trading in '99. I was scalping NASDAQ stocks, okay, for a proprietary firm in New York City. And that was good for the first couple of years. And then things got very hard because they decimalized the stocks. Ranges went from $50 a day to like $3 a day. Suddenly, we had to learn how to trade. So that was really where my learning curve began. I was basically trading futures. I started trading futures in '03, and I wasn't very successful. All right, they were hard because I didn't know how to trade. And then throughout the evolution, I started trading Forex in '06. At the same time, I was learning options trading, and I'm pretty well versed with the options. I don't put on any of those complex strategies. If I do anything with options, it's usually naked shorts or verticals, pretty much. And what I'm going to show you today fits in very well with those two type of strategies. Now, I struggled with consistency for a long time. I'd say at least 10 years, okay? That's a long time. So basically, it would be like you make some money, you give it back. You make some money, you give back some more. You try something else. You make some money, you give it back. Now, you know why I don't have any hair? It was a struggle, okay? And all during that time, I was learning the different aspects of the market. And it got to the point where I knew the basics so well that, you know, it was great. I sounded like an expert. The problem was I still couldn't make money. All right, so it doesn't matter, you know, how much you know. Really what matters is, can you make money and consistently? Now, a lot of options traders, I know we have a lot of options traders here, you know, and I understand the whole option. The great thing about options is the flexibility that they provide, because you can do many different creative things with options. You can do many types of adjustments. You can quantify your risk in many ways. Okay, so options are great instruments. And also, you don't have to be so dependent on direction. Now, I never went the full options route, and I became a directional trader. It's the hardest way to go. All right, if I could go back, I would probably focus more on options because I spent a lot of time struggling. But anyway, the point is, and that brings me to where I'm going with this presentation here, is there are certain pieces of information that I learned that you can pull from a chart. All right, and I'm talking about technical analysis that will keep you in line with what the market wants to do. Because remember, this game is about probabilities, even with the directional trading. You just have to understand when things are more in your favor or not. One more thing I want to mention before I get into some more details here is we are retail traders, okay? And a lot of people don't want to realize what that is or acknowledge what that is. As a retail trader, we are the lowest form of life on the market food chain. And most of the time, our purpose as a retail trader is to feed brokers, especially Forex brokers. Right? They take advantage of us because we're very easy to stimulate. We're always impatient. We want to take trades. We're looking to make money. We're trading our small accounts. We want to double them and have all these unrealistic expectations. We're exposed to the lowest quality information. It could be on Twitter. It could be on TV. It could be whatever. So that is our role in the market for the most part. That's why most of us fail, because we're all clouded by all that nonsense information. We don't know how to focus on relevant information. Okay, and the people that do, they don't exactly want to share it. All right, so I'm sharing you the first step of that. So anyway, that's just moving forward. Do I have any questions so far about anything I mentioned? I'm going to ask from time to time. People have questions. I like to be interactive. I like to make sure people are engaged. Any questions so far? How you guys feeling? You guys still there? You guys sleeping? I want to see some text. There we go.
Here we go.
You guys, only one guy? There's only Gary? Come on, there's got to be more than just Gary.
Hey, Mark, could you move that box? So it's kind of blocking that part of your slide.
The text box. Okay. Move it over here. Who else we got? Sally? Okay. All right, great. Anyone else out there? Come on, say hi. Don't be shy. I want to see the people are listening before I get into this. This is important stuff. Okay, so before I get into it, I just want to mention, too, speaking about distractions, all right, what I'm about to go over is going to be pretty informative. I don't want you to miss it. You took the time to be here. So I would just like to suggest that, you turn your Skype off, turn off your phone, or put it on buzz, or whatever you have to do. Turn off the TV. It's important that you pay attention, because I'm going to get into some details here that may be confusing, okay? That's what I'm going to talk about, George. Where do we get our advantage from? There is a way, and I'm going to introduce that to you. So that's my background. Now, here's the thing. I went through a lot of pain, right? I went through a lot of struggle, and I learned that the biggest one of the biggest complaints I get, from people that I train and things like that, is that I get out too early. You ever experienced that? You get into a trade, and, you took some losses earlier. You get beat up, and you're like, now you have some money, and you take it. And then, of course, that was the big one, right? And you missed the whole move. And it just goes on, and it disgusts you, and you just want to turn the computer off. Have you experienced that? Usually it happens more than once. It's happened to me often over my 15-year or 16-year career now. So I've learned how to get around that. All right, anyway, we're going to get into that. But that's the biggest complaint. Imagine if you had a signal that can keep you in the broader trend, right, and allow you to manage trades with little attention. Because, we're always watching every tick in the market because we're focused on our 5-minute charts, our 30-minute charts. We're so focused on our little setups, and we forget what's happening on the bigger picture. We start paying attention to fundamentals, things like that, which can be very distracting. Now imagine that you can do something like this with your vertical spreads or your naked options. You could be short a put, be short a call, okay, on the following markets: S&P, NASDAQ, Russell, Euro dollar, and crude oil, right? Those are very highly liquid markets, and they're crazy markets, especially oil. And trading the futures outright could be scary, especially as a directional trader, especially if you're trading an account that's less than $10,000. All right, the risks that you can take are very high in these markets. But what if you had a way to get that advantage so that chances are you will have a higher probability of taking a profit out of this thing and not sitting in a 100-point loss, right? Especially when you're trading the bigger picture. So that's where this is what I want you to get out of this. This is the thing right here that took me years to figure out. I'm going to explain the concept now. The biggest mistake that I was making is measuring risk on a small magnitude, meaning like a 5-minute chart, while expecting a large magnitude reward, like a weekly chart. So for example, I'm taking a long in S&P, and I'm saying, okay, I'm going to put my 3-point stop here, and I'm expecting 50 points, okay? And I'm going to try to hold on to this swing trade. Meanwhile, I have no idea where I am in the market. I'm just basing it on a little 5-minute pattern that I learned how to trade, okay? Biggest mistake. This leads to poorly defining perspective. What is strong? How do we define strong? Just as we started this presentation out, Tom said to me, oh, you know, these markets are making new highs, right? They're strong. And I'm saying the U.S. indices are pretty strong. He said, well, I think they're more range bound. How do we define that? Okay. I have a specific way of defining strength and weakness. It took me a long time to learn that. Also, the word trend, people like to throw this word around a lot. And it's relative. It's relative to your chart, to your time frame. It's also very vague. You know, you can have a trend on a 1-minute chart. You can have a trend on a 10-minute chart. You can have a trend on a 4-hour chart. But then the trends could be all conflicting. You can have a bullish trend on your 4-hour chart while you have a bearish trend on your 30-minute chart. How is that? It's because it's how we organize our information. And which one carries more weight? How do we navigate those type of markets? You know, when it's all one way, when they're all up, okay, that's easy, right? It's up. But when they're all conflicted, that's where people get caught and lose money. And that's where we can find opportunities. All right? So it all changed when I realized this one simple thing. And let me show you a chart now, because I know we all like to see charts. Here is a chart. This is Owanda, by the way. This is a chart of the Russell 2000, and these are weekly bars. Okay? We have two types of things that are going on here. I'm going to get into both of them, but the first thing I want to mention is this price action right here. You see my pointer? Can you see my pointer? People watching, let me know if you can see my pointer.
Yep, we can see it.
Okay. So you have the week before, all right? And you have a high and a low. And you have a close. We have a current week. We're above the weekly high. That made a very big difference in my trading. It's very simple. It's like, what's the big deal? Well, the fact that a weekly chart can take out a weekly high or a weekly low, a weekly bar, is very significant for all time frames of trading, whether you're scalping, day trading, or swing trading. This is the first step, all right? That piece of information alone guides most of my decision making. It doesn't mean I'm taking the trade here exactly. All right, a lot of people like to make that mistake, and you can run into a lot of trouble if you do that. When you get choppier markets, you know, you take out the high, you get long, and then you got to sit through all this pain, like something back here. All right, so you can't take that outright. There has to be more to that. But that is the first step. Okay, understanding what this means when you take out a high or you take out a low. All right. Now let me move on here. Any questions about that so far? Pretty simple, right? Pretty simple. I think we can all imagine what we know what that means. All right. So when you have this type of situation, I just want to show you an example with some prices. This is a Euro USD Forex trade right here. Okay. This is actually a trade that I took on a practice account. It's not even a real one. And you can see the size here, right? This is based on a small account because I was showing people how you can trade this method or trade this signal, or what I'm about to show you more detail on any amount of money. The key is the sizing, all right? I'm not going to spend a lot of time on sizing today, but I just want to explain this is what you're looking at here. 2,500 units of euro dollar is 2,500 units. It's like $2,500 worth, all right? The typical size on a Forex trade is 100,000, which makes it $10 a pip. When you're dealing with 2,500 units, it's 25 cents a pip. Why would I take positions so small? Because this was a $500 account. Okay? It's all relative. So you can see the dates, and you can see the activity here, the price activity, the prices that I was doing this. I was selling 1381, selling 1279. Right? I covered some at 1206. Sold more, 1217. Right? We're going into the 11s now, covering 10s, covering 9s, covering 8s, right, into the 7s. You can see the P&L going up. Went from $500 to $650. It happened from February 22nd to March 10th. Okay? So percentage-wise, what is that, like 25% or something like that? Or 30%? Percentage-wise, it's something like that. Okay? I forget the exact percentage in that period of time. This is because the market was doing what? Was anyone trading the euro at this time?
Well, I was watching it go down and helping my mortgage, but I wasn't trading it.
It was trending. That's what it was doing. It was getting annihilated. Okay? And it actually went a lot lower than this. I covered this full thing at 107.43, and the thing went to 104. All right, in the next couple of weeks. Here's another chart. This is real. Okay? This is a real account, not practice. And again, the sizes are bigger because this is a bigger account. And you can see the same situation. Look at the dates from February 9th to 3/6. That's a month of holding on to this and managing the trade throughout. All right, you can see the profit right here for this size. The maximum size here was 25,000 units. All right, that's 2.5 mini lots. All right, again, it's all relative to the account. All right, and there's the profit. Do you have the ability to look at a larger time frame and manage a trade like this consistently? That's the thing. And what I'm going to show you will help you do that. Okay? What are we looking for? Trading directionally is hard and confusing because there's a lot of information coming at us, and we don't know what to do with what most of the time. Measuring and capturing broad market moves is also very challenging and risky. Why? Because the longer you're in a market, the more risk you're taking, number one, because things can change. Some news can randomly come out, and 1 minute you thought you were in a strong market, and then it's losing 200 pips in 5 minutes. You're like, what was that? Some news came out. All right, markets can change very quickly. Is that noise, or is that a serious market move that could be trend changing? So it's very risky. You have to understand what's going on around you, and you have to be prepared for these random events because that's a very high element of randomness in these markets. We face this all the time. This is why sizing is very important. But anyway, before I get further into that, we also are looking for additional ways to align ourselves with the market forces to improve our success. And as an options trader, you're taking advantage of the characteristics that options provide. Okay, they already give you a lot of advantages. When you're short options, for example, you're taking advantage of the time value decay. That's something in your favor, right? That's an advantage. When you have your verticals, your risk is nicely defined and protected. That's another advantage that only options can offer you. You don't have to worry about stops. You don't have to worry about all these things that a random move can just knock you out of. Those are nice benefits of options. But imagine if you can combine the directional element and actually take advantage of the directional element or the natural market forces that can give you that alignment. Okay, that will give you your options advantages plus now you can have a directional advantage as well. What leads to that? What gets us to that point? How do we do that as a retail trader? Well, this is what I learned. All right, this is the answer that I found over many years. Markets are fractal. All right, what that means is you can have things that are happening on a smaller time frame that look the same as the larger time frame. An example of a fractal thing would be like a twig of a tree, right? The little twig with the little leaf, if you look at it, kind of resembles the whole tree. So a whole collection of twigs equals a branch, and a collection of branches equals, part of the tree. And then the trunk looks like a large branch, and the whole thing together is a tree when you zoom all the way out. Those are fractals, okay? The markets operate the same way. They are fractal in nature because they're typically organized by time or time frames, right? We look at a chart, it's a 1 minute chart, it's a 5 minute chart. That's organized by time. It doesn't have to be the only way we organize charts. There are many different ways to organize charts. all right? But I use time. I've learned to use time and understand how time works with markets. So the special process that I base my trading on is on this premise, the fractal nature of time in the markets. Now, broader time frames provide valuable information because of the magnitude of volume. This is weighting, okay? Weighting is in heavy. So when you're looking at something that's happening on a weekly chart, like I showed you with that weekly break before on the Russell, that carries a lot of weight because it takes a lot of volume to do something like that, as opposed to looking at a break of a 1-minute high or a break of a 5-minute high. It doesn't take much volume to do that, all right? When there's a lot of volume, that's like watching like a tidal wave compared to like a little wave coming up to the beach. A tidal wave is going to it's going to carry more weight than your little wave, okay? So that's that example. Price action can be categorized into two things, not just one. People always think trend, bullish, bearish, or flat, right? But there's something else that people miss all the time. And when I train my students and I ask them and I test them, I say, what is this trend and what is this momentum? There's a difference, all right? I define them differently. Trend gives us a general direction, but momentum tells us what's happening right now. So you can have a bullish trend with bearish momentum. What is that? What is the bearish? What do you think bearish momentum in a bullish trend is? There's another word for that. Can anyone tell me? It's a word that we all know, or it's a phrase that we all use in the markets. What do you think that would be? Bullish trend, bearish momentum. Pullback. Who said that? John. Exactly. It's a pullback. That's bearish momentum. On a 1-minute chart, you're going to say it's a bearish trend, but it's not. Don't use the words interchangeably. Keep the words and the meanings specific. This is how we organize our information. A lot of people screw this up, okay? When I learned to separate everything and keep it organized in its own, trend by itself, momentum by itself, it makes things a lot clearer. All right, so I also learned that turning points in supply and demand can express themselves in price patterns, or what I like to call structures. Okay, Elliott wave is very popular for this. You have many different types of consolidating structures, right? Like you have, like a running flat, you have triangles, you have these things, and those are usually continuation patterns, right? Well, it's the same idea that I use. It's not Elliott wave, but I look for a series of price actions that develop into a structure. Let me show you a better example of that instead of me just talking here. So here's the fractal nature that I was talking about earlier. This section over here are weekly bars, okay? So the trend, we have a push, we have a higher high over here and a higher low. That defines our trend. It's bullish. But the momentum, our pullback, John, is bearish. What makes this bearish? Well, we took out weekly lows. Okay, see this red line here? We took out the previous week's low. Here's our current bar. All right. Now, inside of this bar, you see the tail forming. It's an open bar. All right, not the drinking kind. All right, it's a bad joke. But this is an open bar here. That takes us to our daily time frame, or even a 4-hour time frame. These could be daily or 4-hour bars. Now, the trend in the daily is obviously going to be bearish because we're probably going to be looking at a series of lower highs and lower lows. A common mistake would be to short this with a high expectation. You say, oh, I'm going to short it because, I don't know, I'm going to make 100 points or something. All right, bad idea if you're shorting something that's generally strong, that's pulling back. Because the market participants that are really moving this market are looking to get long somewhere, okay? So the momentum, though, can change, again, on the smaller time frame. Remember, we have trend and momentum relative to each time frame. So weekly, we have trend bullish, momentum bearish. Daily, or 4-hour, we have trend bearish, but momentum shifted back to bullish. See the green line? We took out, the current bar took out that previous high, and that changes our mode, or changes our momentum. That's going to be meaningful for all my trading, whether it's scalping, day trading, or swing trading. That's an important piece of information. Now, I could zoom in even further. What happened inside of this tail? All right, what happened in this long tail? Well, here is our hourly chart, or maybe it's a 4-hour chart. This is the reversal structure that we can see. The trend here became bullish when we took out the previous swing high. All right, that's this green line up here. But the momentum shifted first because we took out the hourly high very early on. Don't mistake this for triggers. These aren't trade triggers. These are basically signals to guide the rest of my thought process. Triggers come from more specific information, like the structure that happens inside of this tail. Now, all together, if you put all this information together, what we have is something called context. So context allows me to take a trade on a big picture chart, like a weekly chart. Let's say we took out the weekly high on the next bar, all right? But since we are already strong on the big picture, when I see bullish structures happening on the smaller time frames, such as these, I can start positioning myself with the bigger picture trend at prices that make sense, not up here, okay? Which, on your 5-minute chart, you're getting long up here. Remember I said earlier, the biggest mistake is expecting big profits on small time frame charts, but trying to take small risk. So you're getting long up here and not realizing it. This is your potential risk. You get stopped out a million times because you keep buying this whole way, and finally when you get tired of it, that's when it turns. You should be looking to do the buying at the swing low, okay? You need to always be aware of where you are. But the swing low is not enough. What if you bought at the bottom of the tail thinking you were cool, the next thing opens and then it takes out the bottom of the tail? You're still in a bearish market. You have to know how to manage all that. The smaller time frames can help us refine that, okay? That not only helps me to know what direction that I should be working on aggressively or conservatively, but also how to size my positions, which is a very important aspect, like I was saying before. If I'm trading a $10,000 account or a $20,000 account, my sizes are going to be much different than if I was trading a $100,000 account. I cannot trade those two accounts with the same size. If I do, I'm crazy, okay? So, any questions so far? Any questions about this? This is where things get a little confusing. How are we doing with this? So, any questions? I want to see some. You could say no. It's okay if you don't have one. Say no. I just want to see that you're listening. You could say no. Any questions? No? Okay. So this is clear. This is clear. You guys are grasping this? Okay, great. So what I want you to take away from this, what I'm showing you here, is that whether you're trading verticals, whether you're trading the outright futures contract, you need to be aware of your weekly breaks, the highs and the lows, and your weekly trend. And then you need to be able to translate that, all right, or relate that to the same type of price action on your smaller time frames, the daily high or low break, the 4-hour high or low break, and how not only do you have to relate them individually, but then to each other. That is how you get context, okay? Let's move on. So here's a real chart, all right, that I generated this chart back in February. Remember that trade example I showed you before with those orders? This is the trade signal, okay, that I took. So this is the rationale. This was around February 9th, right, to the 23rd is when the signals were generated. The rationale, and this is posted on TradingView, by the way, which, you could have seen at the time, and it's still there. The broader trend was bearish. That was already predefined, right? That was pretty clear at the time. Because remember, these bars, the result didn't exist yet. I was trading this back here when all it was a little retracement upward at the time on weekly bars. Now, the weekly support was compromised, meaning we took out the previous week's low, okay, around in here. That was in the 1230 area, low 13s, low 12s, okay, in these 2 weeks of candles. 2 weeks of watching this and, taking positions, trying to build a position into those little breaks. I had to take some pain in that, not much, but I had to take some. I had to size properly so that the 140 pips of pain that I took didn't hurt me, okay? So was I adding to a loser? No, I wasn't. The upcoming support, which was 1089 area to the 109 area, which I defined through my methodology, we weren't there yet, but I put here at the time, likely to break. Can anyone tell me why I figured it was likely to break? Can anyone answer that? Why did I think? Because remember, at the time, this didn't exist. At the time, there was no result. At the time, we were just trading up in here. Okay? And I said the support is coming up, and it's likely to break. I didn't know for sure, because it would be a lower low. Gary, great answer. Because it's a weak market, and weak markets make lower lows if it's weak. Now, if it's not weak, then I'm going to get a different result. But if the market's weak, like it was indicating at the time, it should make a lower low. So this support is likely to break. That's definitely an area that I would not be a buyer. Okay, that clears that up. Now, with the support zone more likely to break. Now, I put here if the reversal patterns appear in a zone, which there's a zone in here, this blue box. If reversal patterns appear, notice I put watch for possible intraday opportunities long. Intraday, which means you can get a 30, 40 pip bounce or something like that intraday before it starts pushing lows. Fine. Day trade, scalp, no problem. Low expectation trades. But to buy and hold on, you're crazy. Okay? So looking for short signals on smaller time frames at these price levels, right? Meaning where we're trading at the time, up in here. That was the analysis that I put out, and that signaled those trades that I showed you earlier that led to this. I covered most of it right on the bottom of this second candle. I was covering it in the support zone, the 108s, the 107s, right? We had one more week of lows that I missed. Did I care? No, because I had a nice trade. I made 475 pips in the trade. It was a 790 pip move from the signal to the market bottom. Am I going to cover the market bottom? Most likely not. Okay, I don't know where the market bottom is, and I'm not looking for the bottom. I just want a signal that's going to produce a broad move, or a move on this time frame, and I want to have the ability to build a position as it's moving in my favor, so that as it's winning, I'm winning more. If the trade starts out and the trade is losing, I don't add to it, and if I have to get stopped out, I get stopped out in a small position. Okay, but when I win on a bigger position. That automatically puts my expectancy in the positive. All right, never mind trading signals and tools and all that other stuff. The sizing alone gives me that advantage. Okay, so that's an actual example of the signal that was taken. So speaking of signals, these type of signals don't occur very frequently. You're not going to find them day to day. All right, they occur more on a weekly time frame. All right, you may get one a week, you may get two a week, something along those lines. Depends on the market. I'm looking for a long on the S&P. Let's go take a look at that real quick. And like I said, the Russell gave us one today. All right, the Russell gave us a signal to now focus my attention on. All right, there can be actually a long opportunity in there. I just have to zoom in further. Now, if we zoom all the way out, that long signal is coming up here. You see this when we zoom all the way out, coming up here. The only thing that I have is, when we look at the context of this isn't bad, but should I, if I get involved in this long, do you think I should go in like with a full size position, or do you think I should go in starting small, or like, let's say my maximum size, let's just say is 3 lots, let's just say. Should I go in with all 3 lots? If there was a signal here, if I zoom in and I see some of the things that I like, should I go in with all 3 lots? Or start small? So I should probably go in with 1 lot, right? Because why? Who can tell me why? Why would I do that? Okay. Well, why would I go in with 1 lot if I take a trade at all? Why would I go in with 1 lot? Something like this would be ideal for a vertical spread as well. Well, the thing is, we took out the previous week's high, so that's a good thing. That's a good start, okay? If you just trade just on the breaks of the highs or the lows, you actually can produce, I think it was, we did some research on this. I think it's got like a 65% win rate or 70% win rate if you just take the weekly highs or lows alone without refining it with any context. The problem is, of course, when you get caught up in the noise in these things, they can really chop you up bad. Okay, that's why you have to refine it. But if you take them alone, there's actually a system in there alone. But the reason why I would go in small is because look where we are. We're near recent highs. Okay? This is kind of a risky area. I'd prefer to go long lower. I'd prefer to see a deeper pullback, maybe to a more significant support level, maybe around here. Let's see what numbers those are. This is the CFD, so the numbers may be different from the actual futures. When I do these signals, I actually trade the actual futures off the CFDs. Even though the prices are different, the signals are still the same. I like watching the CFDs because it's just easier for me organizationally. But I prefer to take a long off of a support, like a deep support, much deeper support. A CFD means contract for difference, and CFDs are not available to U.S. traders. CFDs allow you to trade pretty much anything. So if you want to trade, commodities, gold, silver, anything. Well, actually, you can trade gold and silver here. But if you want to trade, let me think of something like, if you want to trade S&Ps, right? But you don't want to trade the same size. When you trade a futures contract, the contract has a specification, right? It's a certain size, and it's going to be $12.50 a tick. And that may be too big for some people. The CFD is $1 a tick. It's a big difference. It gives you more flexibility, all right? That's why so many people lose their shirts in the futures market, because they don't have flexibility, or their accounts are just not big enough for the position sizes that they have no choice but to trade, okay? CFDs solve that problem, and that's why you can't trade them in this country. Anyway, so this is the CFD. Now, because of the context of this trade, I would work it small, because if it pulls back, there's a lot more potential for pullback. I don't want to get hammered, all right, because this thing can pull back significantly. So if you're small, guess what? You have a lot more capacity to handle a pullback. Suddenly you're not afraid. Suddenly it's not stressful, and you're not adding to it, okay? You only add to it when it's winning. Anyway, so that's what I wanted to show you on that. Let me move on real quick. So that is an example of a signal. And again, it's refined when you just look at a time frame like a 4-hour. That's what I wanted to do. Hold on. Let me show you this. So here's the Russell. And look, you realize that the Russell and the S&P and the NASDAQ and the Dow, they're pretty much going to look the same. They all pretty much follow each other with some slight differences, right? So if I take a look at this now on a 4-hour, notice this. So our weekly, was taking out a weekly high, right? When I look at a 4-hour chart, I have a lot of information on this chart that you may not realize. Number one, our momentum and our trend on the 4-hour chart is up because we're making higher lows and higher highs, right? Not only that, we're above the previous 4-hour high, all right? In an uptrend. These are all very bullish signs. Notice though, if you just follow that alone in isolation, it's a bad idea, because this current outside bar took out the previous candle low as well. That's not a short, okay? That's not a short, because the trend is up. Can't forget that. That's where people get isolated with these little, oh, it just took out the low. Okay, it's a short. Maybe if you're scalping, that's one thing. That's fine. But to try to hold on to a position based on that is a bad idea. Okay? That's why I use the word context, because it accounts for everything that's around you in your environment, starting with the biggest picture and going into the smaller picture, so you're aware of where you are and you know how to manage accordingly. So if I've got long here, like I said, our one lot, and then we get a serious pullback, I'm not going to get hammered. But anyway, the other thing I wanted to point out is this. We have this current situation right now, bullish, right? Okay. Notice on this 4-hour chart, from this vertical line to this vertical line, if you notice, how much time is that? Can you tell me? Who knows? From this vertical line to this vertical line, how much time is that? There are 1, 2, 3, 4, 5, 6 bars inside of this column. How much time is that?
Looks like a day.
It's a day. Right, Tom. That's a day. So that means I don't have to look at daily bars, because I have my daily high and low right in front of me on this 4-hour bar, on this 4-hour chart. So I'm looking at my 4-hour bars, which is more refined, right? I can see more detail, but I'm still seeing my daily high and low. So what did we do? We've taken out the weekly high, we took out the daily high, and we took out the 4-hour high. It's all lined up. Wow, that's nice. I don't know why I'm not long. Okay? I should be long. on the break, at least a unit, at least something, okay? The only thing that I said is I don't like the overall position where we are because we're near some pretty significant highs. It's a strong market, so that's good. I adjust for my risk by going in smaller. If we get that deeper pullback, I may have an opportunity to add, but I'm going to have to wait a while until things are looking much more favorable. Because if this momentum turns bearish on me, I'm not going to add during bearish momentum. That's what I mean by going against me. The trade may be against me if I'm adding, right? The trade may be negative on me, but I have to be adding in an environment that's supportive. So if I'm long and I'm seeing all this bearish momentum, I'm not adding. If the momentum shifts and it's bullish again, and I have structures that support that argument, I can add carefully, all right? Even though my initial position may still be against me, but my initial position is small, okay? So anyway, I just wanted to throw some of those concepts at you. Any questions about that so far? I'm going to wrap all this up in a moment. I know I'm throwing a lot at you. What does this kind of stuff do? While you're coming up with your questions, if you have any, I'm just going to continue here. What does all this information do for us? All right, well, for one, if you're trading a larger time frame and you're keeping everything separate, you can stay focused on a smaller time frame strategy like scalping or day trading while you're still involved in the broader trend. A nice example of that, actually I'm going to talk about that in a moment. A nice example of this is trading like the NASDAQ futures versus the Dow futures, right? The mini Dow and the mini NASDAQ. Mini NASDAQ and mini Dow are both, it's $5 a tick, per contract. And they pretty much move in a similar way, all right? Very similar way. So what if you're long one and short the other? You could be riding one on the bigger picture and trading the other one scalping in a way that's almost like hedging. So if one is going against you, you're shorting it on the other side. If you're long one, you're making it back on the shorts, provided that you have the right information to go short with, right? That kind of thing. That's one way to apply something like that. Yes, I do. I have a very well-defined process. What I showed you here is just the premise behind it all, okay? I have a 4-step process, but that's a different thing. That's what I train people how to do. This type of thing requires little or no attention, obviously, because once the trade is on, the only things that you're really looking for are the opportunities to adjust, meaning it could be adding, it could be taking profits off the table, it could be adjusting the stop. That's pretty much it. You know how long it takes to analyze something like that? 5 minutes, not even. 2 minutes. Just look at the chart, see where you are, and you'll know if you have to make an adjustment or not, right? Or if the information can be provided for you. Put on, directional options trades like verticals or like naked options, like I said earlier, with the added confidence of the higher probability. Now, I typically, I'm mostly just trading the outright futures straight. I don't really do this with options because I just don't need to. I'd rather just trade the futures contracts. It's easier on my mind, when I put these things on. So I know we have a lot of options traders here, and somebody asked me earlier, where's our advantage? Well, when you put all this together, you have a much greater advantage because you have your options, flexibility, and now you have a direction. You have signals that are natural to the market that you can follow that will keep you more likely on the right side. Imagine if you can sell a put, in one of these things. So I know the premiums are very high, especially like on the S&P and things like that. Imagine if you could sell a put, a monthly one, off of a market low. You may not be at the low, but off of the low. And as long as the direction is going your way, that time value is going to make you money, right? So that's where I think this offers a great advantage, especially to options traders. Now, what we're doing here, just so you know, and I'm going to answer some more questions here in a moment, is I'm offering signals based on what I just talked about here, okay? There's a 15-day trial, so it's risk-free. Doesn't cost you anything. You can see how they perform. As far as like the statistics, we did some research, like I said, and Mohit, and we learned that just, because we have to simplify it, we learned that I think it was a 70% chance, it was 65 to 70% chance of probability of success or win rate based on the weekly signals alone in isolation, okay? But the thing is, what takes this a step further, the reason why I can't really use that alone is because I'm not taking the weekly signals alone in isolation. I'm looking at them through context, okay? It's very hard to test for context. I've been doing this, I've been applying it this way in this organized form for, I'd say, almost a year, you know, and it's been working well. I mean, I showed you that Euro trade that I did, and I had an oil trade. I had a couple other trades, S&P trades that worked out very well. Okay, in fact, I was able to take one of my accounts up 60% in a 2-month period because of that. So, you know, it's relatively new. Like, you know, a year or less than a year is still kind of relatively new. I understand what your concern might be on something like that. That's why we're also doing this with a 15-day risk-free trial. All right. The URL is right there. It gives you all the details. Now, the signals that are generated will come by email or SMS, whatever you decide, and you don't have to worry about analyzing anything or having to stress out about the market. You just, if you want to place the orders, you can place them, and you just step aside because these are low maintenance. This isn't day trading or scalping. It's based on the same premise that I use for day trading and scalping. Yeah, this is for FX and futures. Those are, in fact, the markets that I'm following. Actually, I'm going to get into some Q&A here. But the markets that I'm following are the S&P 500 futures, all right, NASDAQ 100 futures, Russell 2000 futures, the euro dollar. That's the only Forex or futures market. You can apply it to the futures as well, but that's the only spot market that I'm going to be focusing on is euro dollar because it's just, you know, you're just trading the dollar on most of them anyway, the U.S. dollar. So there's really no reason for me to look at, you know, pound and Aussie and all those other things. For the most part, it's the dollar. Okay, so I just focus on euro dollar. I know there's different fundamentals that can affect them, but I just like that market the most. And of course, crude oil. Now you can look at the CFDs for these, or you can look at the outright futures contract. The signal is the same. All right, so the signal consists of the context of what's going on plus that weekly break that I mentioned. Okay, so you know, if you sign up for something like this, again, you have 15 days to observe, to see what kind of signals you get. Signals aren't going to be very frequent. You may get 1 or 2 a week, okay? 1 or 2, depending on the market. After 2 weeks, if you don't cancel, obviously you get charged. And this is perfect for futures traders or Forex traders who don't have time to trade, or options people who are looking for a directional strategy on a longer time horizon. Okay, so it's just another strategy for you to consider. Put on your verticals, you put on your nakeds, and just let them ride. So this is your chance.
Hey, Mark, just a quick clarification, that URL, there's no www in it.
Oh.
Yeah, pasted it in the chat with the correct one.
I didn't realize that. Sorry.
Oh, no problem.
Okay, thanks for pointing that out. So, well, before I move forward, let me just open up the forum now for questions. Okay, any questions about like what I'm doing here, how I'm doing it? Because the key takeaway, the key point that I want you to take away from this, you know, whether you sign up for this or not, you know, there's no pressure here. You don't have to sign up. It doesn't matter. I want you to take away that when you're trading, whether it's options, whether it's outright futures, you always have to be aware of your bigger picture. You always have to be aware of what's happening on your weekly charts. Not just stare at the chart and say, oh, the trend is up. There's more than that, okay? You have to ask yourself many questions. Did we break the weekly high? Did we break the weekly low? Is that with the trend? Is that against the trend? Now, what's a smaller time frame doing relative to that? Okay, how does that all fit in? Should I be taking day trades? Should I be taking swing trades? All right, the NASDAQ, this previous few days, I've been scalping the NASDAQ futures because I'm not comfortable buying and holding at these levels. I'm not going to do it at these levels. But scalping, I have no problem. Long and short, no problem. Okay, using the same concept. So it's the beginning of a framework. All right, any questions about that? Strategy questions? Questions about how the signals work?
I had a couple questions Mark,
Sure.
when you do a signal, is it going to be intraday or is it going to be end of day or 24 hours? When do you anticipate sending the signals out?
Well, I'm anticipating over 24 hours, like, it could be any time of the day because these are swing trades. And it depends on when things are happening, really. Like, so for example, a weekly high, just like in the Russell, I was just looking at the Russell, that weekly high was taken out, right? So what I would be doing is I'd be looking at the smaller time frames right now just to see what's happening there at those levels. And we looked, and to generate a signal. Now, there was obviously one there. I could have put one out, but I'm doing this webinar, so I'm not going to put it out now. Now we need to see a pullback of some kind before I do something with that. But that's an example. Okay.
And
So it can happen anytime during the day.
And the signals for the U.S. equity markets like SPX, Russell, are those on the actual futures or are those based on the indexes?
The signals will actually come from the CFD. Okay, so this market here, the CFDs look like this. Like this here is the Russell CFD. This is not the outright futures. So the price of this is probably going to be different. Actually, let's take a look at a NASDAQ example. But this is where they're going to come from. Okay, so when I look at the NASDAQ 100, all right, according to this, hold on a second. According to this, right, 44.96. The actual futures are at 44.89. Okay, I mean, it's close, but there's a discrepancy because this is a CFD. The signal is a signal. Okay, but the price that I may give you the signal on may be based on this. Okay, depending on the market. So I don't really think that should cause much confusion because, the signal is still a signal. Does that answer your question?
Yeah, I think so. So
if this is a long generated, sorry, go ahead.
If you're going to try and trade this, say, with options during the U.S. market hours, you may or may not be able to if the signals are happening outside of the U.S. market hours, right?
They can, but again, these are the U.S. indices, so usually a lot of the time you're not going to get a signal after 4:30 anyway.
Okay, so the CFDs don't trade 24 hours like the futures?
No, they do, but again, they're based, this is the NASDAQ CFD. If the NASDAQ's not moving, this thing's not moving either.
Right, okay.
So it's pretty much, a lot of times in these markets, the signals are pretty much, during market hours. The only ones that you may get outside of that is like the euro dollar or oil, because they tend to have things that happen overnight a lot more. Okay, if anything. Good questions. Any other questions? Steps.
I had another one. If you have a signal, are you providing entry prices, or are you just saying like go short or long, this underlying?
Well, yeah, there'll be an explanation. That's what you mean. Like it'll be, so it would say, hey, NASDAQ 100 long at this price. Of course, there'll be a stop. There'll be an expectation because these type of trades, these aren't day trades. So the expectations are going to be high on these things. So, for example, a trade that I'm looking for is to be long NASDAQ around the low 43s or high 42s if we can get back there. If we get back there and we start generating signals, then you're going to see a signal come out for a long from those, from those levels, and I'll be looking for something like 100 points, or more as an expectation. That is not going to happen in one day. That can happen over a week or two, depending on how that thing moves. Okay, but that's an example of what a trade would sound like and the kind of expectation that I'm looking for at this magnitude. Because I'm only sticking to this magnitude. I'm not doing day trading or scalping signals.
Right. Mo had asked, do you have any history of performance?
I don't have anything that I can show you right now. So I would suggest that you have the trial, try the trial out, see if you like the signals, use some of your judgment on that, because I'm starting this officially here with capital discussions. So I'm going to be building a history here with this.
Now you trade intraday for yourself and you teach. I know you've been doing that for a long time.
Yes.
So
I
have a history of being profitable, but not necessarily of doing these signals on these time frames with the history.
Right. The thing is this. What I do intraday, the day trading, the scalping, it's based on the same premise. The only thing is I took it to a different magnitude, right? So that's where the weekly stuff comes in. I'm day trading, I'm scalping. Those signals are frequent and they can be very confusing at times. I think it'd be too much for me to actually put those out. So I figure weekly, it's simple, it's easy, and the moves are broad. And that's where there's a lot more money to be made, in my opinion, with a lot less stress, as long as you are sized properly. And I'll put some information in there about that as well so you have an idea. But it's all really relative to your account size, the sizing, when the sizing comes in. But I also I train people. I run a website called unconventionaltrader.com. I do group mentoring and I do one-on-one. And I don't trade, I get these traders that come out and they say they train thousands of people. Well, I don't do that. I've trained in the 2-year period, I've trained maybe a handful, maybe 20 traders, maybe 30 traders. But the difference is quality, right? Most of them I see a big difference in from when they start, and a lot of them become consistent. Okay, not all of them, but a lot of them, because I focus on quality. I give them a lot of information and we refine it. It's a process. Most of my traders stay with me for an average of 6 to 9 months. They don't have to. There's nothing in my training that says, this is a 6-month training program. They stay with me because that's how long it takes them to get the benefit that they need. And then once they have the benefit, they can move on. That's my experience with that so far. But the people that, I wanted to include some testimonials in here. I just didn't have the time to gather them. But I have some of people that have trained with me. Do you analyze trading volume to enhance signal generated? Okay, George, good question. Actually, I do not look at the volume specifically. I'm focusing mostly on the price action. But the purpose behind using the larger time frames is really about the volume. Okay? Because in order for the markets to move a particular way on those time frames, a lot of volume has to be generated. So in that sense, I do have a sense of volume. But to look at volume statistics specifically, no. I used to look at volume, like the volume footprint for the futures of executed volume. I used to do all that craziness, and I found one thing. That stuff is only good for scalping, and nothing else. Okay? You analyze? Yeah, okay. So does that answer your question? Broad moves usually come from a lot of volume has to be generated for the broad moves, institutional type of volume. And they can't escape larger time frames. They really can't. They make themselves obvious by certain types of market behavior. Is momentum closely related to order flow? That's a good question, George. Is momentum related to order flow? Not the way I define it. Okay, I guess it depends on how you define it. It can be. I define momentum as just basically it's, you have something like trend. Trend is an overall broad, you have a direction in the market. It's making a new high. It pulls back to a higher low. It makes another high. It's a new high. The trend is up. But when it's pulling back, what do you call that? And that's where I use the word momentum, because you have bearish activity, but don't call it a trend because your trend is up. Once you start saying, whoa, I have a bull trend, but now I have this little mini bear trend, that gets confusing, right? Because what trend? What trend are we talking about? But if you say, my trend is up, but my momentum is bearish at the moment, that's a different story. Oh, I'm sorry. Can you excuse me, Tom? Can you just, hold on 1 second. 1 second.
Yeah. So I've known Mark for a couple of years now. We both did some work with SMB. In fact, Mark used to be the futures Forex guy at SMB training. And I've always had a lot of respect for Mark. Yeah, he does good work. I would expect if you're going to trade his signals with options, that probably 30-plus days would be appropriate. You probably wouldn't want to do like a 1 or 2 week expiration if the signal is going to move a couple, 3-4 weeks. Hopefully Mark will be back here shortly.
Okay, guys, I'm sorry about that. Can you hear me?
Yep.
Okay, sorry. Anyway, so no, that was an important. I normally wouldn't do that, but the call, yeah, this is an important call. I'm sorry. Okay, so did I answer the question about the order flow and the momentum? Is that clear? Okay. Any other questions?
Doesn't look like it, and we've actually hit our hour, so this is probably a good place to stop. Now, the prices for the service that you're going to have are actually going to go up after midnight on Sunday, so this is kind of introductory pricing. It's going to go, I think, to $89 a month after Sunday. So if you think this is something you might be interested in, do the trial because it doesn't cost anything for 2 weeks plus, and it's a good stuff that Mark has. I'm looking forward to seeing your signals, Mark.
Yeah, thanks. I think you'll like them. Yeah, is that the right address? Look, I just did it right here spontaneously.
Yep, that's the one.
Okay. So yeah, it's $67 to start, and that's, again, you have 15 days to even decide if you want to pay that. So I think it's a good offer anyway. But you have till Sunday to do that. If you miss that, then it starts at 89. So take advantage of it. Definitely take advantage of it. All right. So I'd like to thank everybody. So either we do the free trial or the intro pricing is available to you now with the free trial. So you have the free trial. It's just you have this because you came here today. You have a chance to get the lower price, to lock in the lower price if you sign up before. You take the free trial now. There's no risk to you, and if you decide to go with it, you get the lower price because you came today. But you only have until Sunday night.
Yeah, you do the 15-day trial, and then it'll start at $67 a month. But if you don't start your trial until Monday, then it'll bill at $89 a month.
Okay. So, all right, you guys. Well, I want to thank you all for listening to me today and taking the time.
Yeah, thanks, Mark. It's always a pleasure. Hope to see you more often on the roundtable. Yeah,
I'd love to come back. So we'll see if people. You should do a survey, Tom, to see if they like me, and then we'll see if I can come back. How about that?
Yeah. And George, to answer your question, once you lock in at the introductory rate, as long as you maintain that subscription, the price will never go up. So it's a pretty good deal, really.
Yeah. All right, you guys. Well, thanks a lot. I hope you guys found something useful. I hope you guys can take something out of this, whether you sign up or not. I really hope you can improve your trading from what I learned here. And that's it. Great. So enjoy the rest of your evening, everyone, or your day, or wherever you are. Have fun. I hope you trade well.
Thanks, everyone. All right, bye-bye.
All right. Bye, Tom.